Somewhere in the world, in the time it takes you to watch this video, several billion dollars of criminal money will disappear. Not into a vault, not under a mattress, but into the ordinary economy you live in. Into apartment towers, into art auctions, into the pension fund that will one day pay for someone's retirement. The money will not vanish. It will be everywhere. And that is exactly the point. The most successful financial crime on earth is not the one that hides money away. It is the one that hands it back to you, freshly pressed, and dares you to notice. The United Nations Office on Drugs and Crime estimates that between 2 and 5% of global GDP is laundered every single year. In today's dollars, that is somewhere between $800 billion and $2 trillion. A shadow economy roughly the size of a major nation, moving quietly through the same banks, the same wire systems, the same glass towers that hold your salary. And here is the unsettling part. Nobody can tell you the real number because the entire purpose of the exercise is to make the number impossible to find. Think about what that means. Every year, an amount of money larger than the economy of most countries has to be washed clean of its origins. The drug sales, the bribes, the stolen state funds, the human trafficking, the sanctions-busting oil. It cannot stay as suitcases of cash. Cash is heavy, it rots, it gets seized, and it screams its own guilt. To be useful, dirty money has to become boring. It has to become a mortgage payment, a corporate invoice, a wire transfer between two companies you have never heard of in two countries you will never visit. This is the strange genius of money laundering. Robbery takes something from the world. Fraud invents something false. But laundering does neither. It simply changes the story a pile of money tells about itself. The dollar bill does not change. What changes is its biography. And crafting that false biography at industrial scale across borders through the world's most respected financial institutions is one of the largest and most sophisticated ongoing operations in the global economy. Over the next 45 minutes, we are going to follow that money. We will watch it enter the system, disappear into a maze of shell companies, and walk back out wearing a suit. We will meet the banks that moved it, the branches that made history, the fugitive who bought a super yacht with a nation's savings, and the political fight happening right now in Washington over whether any of it will ever truly be stopped. But to understand how the money gets clean, we first have to understand a word that, contrary to almost everything you have been told, was not born in a laundromat. There is a story almost everyone has heard. Al Capone, the story goes, bought a chain of laundromats in 1920s Chicago so he could mix his bootlegging profits with the coins from washing machines. And that is why we call it money laundering. It is a wonderful story. It is also almost certainly false. Commercial self-service laundromats did not exist in the United States until 1934. Capone had already been convicted and sent to prison in 1931, and not for laundering anything, but for tax evasion, the very crime that laundering is designed to prevent. The phrase we actually use did not enter the public vocabulary through a gangster at all. According to the Oxford English Dictionary, one of the earliest appearances of money laundering in print came in the early 1970s, in American newspaper coverage of a very different kind of crime: Watergate. Investigators found that money used to fund political dirty tricks had been routed through Mexico and back to disguise where it came from. The metaphor stuck because it was perfect. You take something soiled, you run it through a process, and it comes out looking clean enough to wear in public. But the metaphor also hides something. Laundry is simple. You put dirt in, you take dirt out. Real money laundering is nothing like that. It is not a wash cycle. It is a disappearing act performed in slow motion across the entire architecture of global finance. And the reason it works is that the modern financial system was built deliberately to move money quickly, privately, and across borders. Every feature that makes banking convenient for you, instant transfers, corporate secrecy, offshore accounts, the sheer volume of daily transactions, is also a feature that makes hiding money easier. That is the uncomfortable truth beneath the metaphor. Money laundering is not a bug that criminals exploit in an otherwise clean system. It is a shadow that the system casts by its very design. The same tools that let a legitimate company in Germany pay a supplier in Singapore in seconds are the tools that let a cartel in Sinaloa turn street cash into a skyscraper in Manhattan. The launderer does not need to break the machine. He only needs to feed it and let it run. So if the metaphor of the laundromat is too simple, what is the machine actually doing? How does a mountain of guilty cash become an unremarkable line on a bank statement? For decades, investigators, regulators, and the criminals themselves have understood the answer in 3 distinct stages. 3 doors that dirty money must pass through to come out clean. Understand those 3 doors and you understand the entire trade. The Financial Action Task Force, the international body that sets the global rules for fighting dirty money, describes laundering as a 3-stage process. Every launderer, from a small-time dealer to the architect of a billion-dollar state theft, is solving the same 3 problems in the same order. The names are dry: placement, layering, integration. But the logic behind them is the entire game. And once you see it, you will start to notice it everywhere. The first door is placement. This is the moment of maximum danger when raw criminal proceeds, usually physical cash, first touch the legitimate financial system. A duffel bag of $20 bills from drug sales is useless for buying a house or company. It has to get into a bank account or into an asset without setting off alarms. Placement is where most launderers get caught because cash is bulky and suspicious, and because banks are legally required to report large or unusual deposits. Solving placement is the hardest and riskiest part of the whole operation. The second door is layering, and this is where the artistry lives. Once the money is inside the system, the goal is to separate it from its criminal origin by moving it, again and again, through as many transactions, accounts, companies, and countries as possible. Each move is a layer of distance between the money and the crime. A wire from a shell company in the British Virgin Islands to a shell company in Cyprus, then a loan from that company to another in Latvia, then a payment for consulting services that were never performed. By the time investigators trace one strand, the money has already braided itself into 1,000 others. The third door is integration. This is the payoff, the moment the now clean money re-enters the visible economy as apparently legitimate wealth. It buys the penthouse, the yacht, the football club, the shares in a respectable company. On paper, it looks like the fruit of successful business. There is no longer any obvious link to the crime that created it. The money has a new life story, complete with documents, and it can be spent in daylight without fear. Placement gets the money in, layering hides where it came from. Integration lets you finally enjoy it. Hold these 3 doors in your mind because everything that follows is a variation on them. The cartel smurfing cash through a Mexican exchange house is solving placement. The oligarch spinning money through 75 offshore companies is running layering at industrial scale. The fugitive financier buying a Monet and a super yacht is performing integration in the most extravagant way imaginable. Same 3 doors, wildly different budgets. And to understand why placement is the deadliest of the 3, we have to look closely at the single most incriminating thing a criminal can possess: a very large amount of cash. Cash is the criminal's first love and his greatest liability. For the street-level economy of drugs, extortion, and trafficking, physical currency is the only medium of exchange. Anonymous, instant, universally accepted. But at scale, cash becomes a curse. $1 million in $20 bills weighs over 50 kilograms and fills a large suitcase. The proceeds of a serious trafficking operation are measured not in briefcases but in pallets, in rooms stacked floor to ceiling with shrink-wrapped bricks of currency that cannot be deposited, cannot be wired, and cannot be spent on anything that leaves a record. To solve placement, launderers attack the reporting threshold. In the United States and many other countries, banks must file a report for cash transactions above a set amount, famously $10,000. So the money is broken into pieces just below the line and deposited by an army of people across many branches in many days. The industry has a name for this: structuring or smurfing, after the small blue cartoon characters, because the work is done by countless little helpers, each carrying a small load. It is tedious, it is risky, and it is the beating heart of the placement problem. The more elegant solution is to hide cash inside a business that is supposed to handle a lot of it. A car wash, a nail salon, a nightclub, a chain of restaurants, a parking garage. Any enterprise where customers pay in currency and no one can easily prove how many of them there really were. The launderer simply inflates the takings, blending dirty cash into the legitimate till and paying tax on the total. The tax is the cost of doing business. The reward is a clean, documented, plausible source of income. This is the true meaning behind the laundromat myth, even if Capone never lived it. Casinos occupy a special place in this world because they are cash factories by design. A launderer can walk in with dirty money, buy chips, gamble lightly or not at all, and cash out with a casino check that looks like winnings. Winnings being one of the few forms of income the world accepts without asking hard questions. Around the globe, from Macau to Las Vegas to the border towns of Latin America, casinos have served again and again as scrubbing stations, where the origin of money is quietly rinsed away at the cashier's cage. But placement, however clever, only gets the money through the first door. A pile of cash turned into a bank balance is still dangerously close to the crime that made it. One good investigator, one subpoena, and the trail leads straight home. To be truly safe, the money must now vanish, not physically, but forensically. It must be moved so many times through so many hands that following it becomes not just difficult, but practically impossible. This is the second door, and it is where money laundering stops being a street crime and becomes a global profession. Layering is the art of manufactured complexity. Its purpose is not to move money toward a destination, but to move it away from its past. And the tool that makes it possible is one of the most quietly powerful inventions in modern commerce, the shell company. A shell company is a business that exists only on paper. It has a name, a registration certificate, a bank account, and often a real address in a real office building. But no employees, no products, no genuine activity. Its only function is to hold money and to sign documents. And in the world of laundering, it is the equivalent of a mask. The magic of the shell company is that it breaks the link between a person and their money. When you wire money, your name is on it. When a company wires money, only the company's name is on it. And if the true owner of that company is hidden behind lawyers, nominees, and a second company in another country, then tracing the money to a human being can take investigators years if they can do it at all. Stack these companies in a chain across several secrecy-friendly jurisdictions, and each border you cross adds a wall that police must climb with a separate court order in a separate language. The transactions between these companies are where the real theater happens. Money moves as loans that will never be repaid, as fees for consulting that never occurred, as payments for goods that were never shipped. This last technique, trade-based laundering, is one of the most powerful of all. A shell company issues an invoice for a shipment of, say, electronics, wildly over or underpriced, and money moves across a border disguised as ordinary international trade. Buried inside the trillions of dollars of legitimate global commerce, a few billion in dirty transfers are almost invisible. The genius of layering is that it exploits scale and speed against the very people trying to stop it. The global financial system processes an astronomical volume of transactions every day, and the overwhelming majority are perfectly legal. Investigators are looking for a handful of guilty needles in a haystack made of other needles. Every additional layer, every extra company, country, and transaction multiplies the work of untangling the web while costing the launderer only a small fee and a little time. Complexity is not a side effect. Complexity is the product. And this is the point at which laundering stops being something a criminal does alone. Building and running these structures, registering the companies, opening the accounts, drafting the fake contracts, finding the compliant banks, requires professionals, lawyers, accountants, company formation agents, and bankers who either look away or actively help. An entire service industry exists to perform layering on behalf of clients who never want their names to appear. When that industry runs at full capacity, it stops being a series of individual crimes and becomes something that looks disturbingly like a machine. The world has a name for these machines. It calls them laundromats. Integration is the door where the money finally comes home, and it is the stage most visible to the public because this is where laundering turns into lifestyle. After placement has slipped the cash into the system and layering has scrubbed away its history, the money re-emerges as clean wealth that can be spent, invested, and displayed without fear. The challenge is no longer to hide the money. It is to hold it in a form that is valuable, stable, and ideally, quietly appreciating in price. Real estate is the crown jewel of integration, and for good reason. Property is expensive, which absorbs vast sums in a single transaction. It is stable, holding value across decades. It generates legitimate income through rent, and in many of the world's most desirable cities, it could until very recently be bought anonymously through a shell company, with no one ever checking who truly owned the keys. A launderer could turn $100 million of stolen state funds into a portfolio of luxury apartments that appreciate in value, earn rent, and can be sold later for money that is, by then, utterly clean. Beyond property, integration reaches for assets that combine value with discretion. The art market has long been a favorite because a painting can be worth tens of millions. Its price is a matter of opinion rather than fact, and ownership can pass privately, sometimes without the work ever leaving a Freeport warehouse. Luxury goods, super yachts, private jets, sports teams, vineyards, and stakes and glamorous businesses all serve the same purpose. They convert an anonymous bank balance into a tangible trophy that also happens to launder its own origin story. The final and most sophisticated form of integration is to buy into legitimate business itself. To acquire a real company, a hotel chain, a construction firm, a bank. Now, the dirty money is not just hidden, it is generating more clean money, blending endlessly with genuine profits until the two are impossible to separate. At this point, the launderer has achieved the ultimate goal. The crime is not merely concealed. It has become a productive, tax-paying, job-creating part of the visible economy, defended by accountants and celebrated at ribbon cuttings. Placement, layering, integration. 3 doors, 1 journey from guilt to respectability. On the scale of a single criminal, it is a clever hustle. But the mechanism does not care about scale. Feed it the proceeds of an entire kleptocracy, staff it with obliging bankers and offshore lawyers, and the same 3 doors can process billions of dollars for years without interruption. To see what that looks like in the real world, not as theory, but as an operating enterprise with a name, a bank, and a body count of shell companies, we turn to the laundromats of the modern era. In 2019, a consortium of journalists led by the Organized Crime and Corruption Reporting Project revealed the workings of a system they called the Troika Laundromat. And it read less like a crime than like a corporation. Built around Troika Dialogue, once Russia's largest private investment bank, the network moved an estimated $4.8 billion out of Russia and into Europe and the United States between 2003 and early 2013. When investigators counted every internal transfer, the companies in the web had shuffled money between themselves to the tune of nearly $9 billion. The same funds spun in circles to bury their trail. The architecture was a masterclass in layering. At the center sat dozens of shell companies, at least 75 of them registered in the British Virgin Islands, a single tiny tax haven, funneled through a now-defunct Lithuanian bank called Ūkio Bankas. These companies issued invoices to one another for goods that were never delivered and services never rendered. A merry-go-round of fake trade that let money enter as something dirty and exit as something ordinary. To shield the wealthy people who truly benefited, the operators used the identities of poor and unwitting individuals as the paper signatories of the offshore firms. What makes the laundromat so instructive is not just its size, but its output. What all that clean money was used for. Investigators traced funds flowing to buy shares in state-owned companies, to purchase real estate inside Russia and across Europe, to acquire yachts, to settle medical bills, and even to hire music superstars for private parties. Among the beneficiaries was a cellist named Sergei Roldugin, a childhood friend of Vladimir Putin, whose associated companies received at least $69 million. A professional musician sitting on paper atop a fortune. The Troika Laundromat was not unique. Journalists and investigators have since mapped a whole family of these systems. The Russian laundromat, the Azerbaijani laundromat, and others. Each a semi-industrial pipeline for moving money out of the former Soviet sphere and into the respectable West. They shared the same DNA, clusters of shell companies, compliant banks in small European states, oceans of fake invoices, and a discreet welcome at the other end from the financial capitals of the world. The dirty money did not stay in the shadows. It flowed toward the brightest lights in global finance. And that raises the question these investigations always eventually reach. The launderers build the maze, but the maze runs on rails owned by someone else. Every one of these operations depended, at some crucial point, on a real bank with a real license moving the money and choosing not to ask too many questions. The shell companies are the disguise. The banks are the road. And when we follow that road to its most notorious example, we arrive at an institution that was not a small Baltic bank or an offshore boutique, but one of the largest financial institutions on the planet. In December 2012, the banking giant HSBC agreed to pay United States authorities $1.92 billion to settle allegations that it had allowed its branches to be used as a conduit for dirty money on a staggering scale. Prosecutors laid out how the bank had moved at least $881 million that they linked to the Sinaloa cartel and other Mexican trafficking organization, the profits of an industry measured not only in dollars but in tens of thousands of dead. This was not a rogue teller. This was a systemic failure at one of the most powerful banks in the world. The details exposed by a United States Senate investigation that summer, in a report running to more than 300 pages, were damning. HSBC's Mexican operation had been treated as low risk despite obvious warnings. Cartels reportedly designed boxes to precise dimensions so they could pass cash more efficiently through the teller windows of HSBC branches. And beyond the drug money, the bank's affiliates had stripped identifying information from wire transfers to sneak transactions linked to sanctioned nations, Iran, Libya, Cuba, Sudan, and Burma, past United States controls in amounts that regulators said exceeded $660 million, and yet no one went to prison. Rank-and-file prosecutors had reportedly prepared a list of up to 175 criminal charges, but the case was resolved with a fine and a 5-year period of monitored probation rather than an indictment. The reasoning made explicit at the time was that criminally charging a bank as large and interconnected as HSBC might destabilize the financial system itself. Critics gave that reasoning a name that has haunted regulators ever since: too big to jail. The bank's head of compliance resigned during the Senate hearing, but the institution simply paid and continued. The fine sounded enormous, but set against the profits and scale of a global bank, $1.9 billion was closer to a speeding ticket than a death sentence, an amount the bank could earn back in a matter of weeks. And the deeper lesson was that the punishment fell on a corporation, an abstract legal person, rather than on any individual who had made the decisions. The money moved, the cartels got their laundering, and when the reckoning came, it was paid in shareholders' cash and absorbed as a cost of doing business. If a single bank could move that much for that long, the natural question was whether HSBC was an outlier or an example. The answer, uncovered piece by piece over the following years, was profoundly uncomfortable, because HSBC was not the only global bank to have opened its pipes to narco-dollars, and it was not even the largest. To understand just how much criminal money the respectable banking system was willing to move, we have to cross the border into Mexico and follow a river of cash that dwarfed anything the cartels had managed before. In March 2010, another banking giant quietly admitted to one of the largest laundering failures ever recorded. Wachovia, at the time one of the biggest banks in the United States, acknowledged that it had failed to properly monitor an almost unimaginable sum of money flowing through Mexican currency exchange houses, the Casas de Cambio, between 2004 and 2007. The figure that emerged in the settlement was not millions and not billions in the low single digits. It was $378 billion, a sum roughly equivalent, at the time, to a third of Mexico's entire annual economic output. The mechanism was almost mundane in its simplicity. Mexican exchange houses collected dollars, including, prosecutors alleged, the cash proceeds of the drug trade, and deposited them into accounts at Wachovia through wire transfers, bulk cash shipments, and pouches of travelers' checks. The bank provided the pipes, the cartels provided the water. Because the transactions were dressed as ordinary commercial currency exchange, and because the volume was so vast, the dirty flows blended into a torrent of legitimate business. The alarms that should have screamed never sounded. The human cost behind those numbers is what transforms this from an accounting story into a tragedy. The same years that saw hundreds of billions of narco-dollars sail through the banking system were the years Mexico's drug war exploded into open slaughter with tens of thousands killed. The cash that Wachovia processed was the financial exhaust of that violence. The reason trafficking pays, the reason the killing is profitable. Every laundering pipe is, at its far end, connected to a real-world crime. And here the crime was measured in graves. And once again, the consequence was a payment, not a prosecution. Wachovia, by then absorbed into Wells Fargo during the 2008 financial crash, resolved the matter for around $160 million. A forfeiture and a fine that together amounted to a rounding error against the $378 billion that had passed through. No executive was jailed. The bank had cooperated, the file was closed, and the institution moved on. The pattern set by HSBC held, the fine is paid, the shareholders absorb it, and the machine keeps running. 2 banks, 2 colossal failures, and in both cases a punishment that barely registered. It would have been comforting to believe these were isolated scandals, dramatic exceptions from a decade of lax oversight. But in 2020, a leak of secret government documents would blow that comfort apart, revealing that the movement of suspect money through the world's biggest banks was not a series of accidents at all, but a routine, documented, and largely unstopped feature of the system. The banks, it turned out, often knew exactly what they were moving. They filed a report, and they moved it anyway. On the 20th of September 2020, the International Consortium of Investigative Journalists, working with BuzzFeed News and more than 100 media partners across dozens of countries, published an investigation that gave the public its clearest ever view inside the machine. It was called the FinCEN Files, named for the United States Treasury's Financial Crimes Enforcement Network. At its heart were around 2,100 suspicious activity reports, confidential documents that banks file with regulators when they spot transactions that might be criminal, covering more than 200,000 transactions worth over $2 trillion. $2 trillion of flagged suspect money. And here was the revelation that stunned even seasoned investigators. These were not transactions the banks had missed. They were transactions the banks had noticed, formally reported as suspicious, and then processed anyway. Filing a suspicious activity report, it turned out, functioned less like slamming the brakes, and more like leaving a paper trail while the money kept moving. The report satisfied the letter of the law. The dirty transfer sailed through regardless. Compliance had become theater. The files named names, and they were the biggest in banking: JP Morgan Chase, HSBC, Standard Chartered, Deutsche Bank, and Bank of New York Mellon. 5 global institutions that had continued to move money for shadowy clients, even after being fined for earlier failures. The numbers attached were staggering. The documents flagged over $500 billion in transactions at JP Morgan alone, and $1.3 trillion at Deutsche Bank. These were not obscure banks in distant tax havens. They were the pillars of Western finance, the institutions that hold ordinary people's savings and government's bonds. Perhaps the most sobering fact was one of proportion. The leaked reports, as vast as they were, represented less than 0.02% of the millions of suspicious activity reports that banks had filed over the same period. This was not the whole iceberg. It was a single chip off its tip, and even that chip contained $2 trillion of suspect flows. The full scale of what the system was quietly waving through could only be imagined, because almost all of it remained locked away in confidential filings the public would never see. The FinCEN Files made something undeniable. Money laundering on the grand scale is not a failure of detection. Very often, the money is detected, documented, and moved anyway. Because stopping it is costly, because the clients are profitable, and because the penalties, when they come, are survivable. But the files were snapshots, thousands of individual reports. To understand how a single institution could become a laundering engine of historic proportions, we need to zoom in on one bank, one small branch in one small country, that quietly processed a sum so large it may be the greatest laundering scandal ever brought to light. Estonia is a country of just over 1 million people, and Danske Bank's branch there was a minor outpost of Denmark's largest lender. Yet between 2007 and 2015, an estimated 200 billion euros of suspicious transactions flowed through that single small branch. A figure so large it defies comparison, dwarfing the entire economy of Estonia many times over. It is widely described as possibly the largest money laundering scandal in European history, and perhaps in the history of the world. And it happened not in a shadowy offshore haven, but inside a respectable Nordic bank, celebrated for its stability. The mechanics were the now familiar machine, running at maximum throughput. The Estonian branch served a book of non-resident clients, companies and individuals from Russia, from the former Soviet states, from a long list of higher-risk jurisdictions. Money poured in from Estonia, Russia, Latvia, Cyprus, and more than 150 other countries, much of it channeled through exactly the kind of anonymous shell companies we have traced throughout this story. The branch was, in effect, a giant placement and layering facility bolted onto the side of a trusted European bank. What allowed it to run for 8 years was a failure of will as much as a failure of systems. Warnings were raised internally and by outside observers, and for years they were not acted upon with the urgency the numbers demanded. The branch was profitable, the non-resident business was lucrative, and the distance between the head office in Copenhagen and the small branch in Tallinn provided just enough deniability. By the time the scandal broke fully in 2017 and 2018, the damage was historic. The bank's chief executive resigned, and the Estonian authorities forced the branch to close. The reckoning stretched across years and borders. In December 2022, Danske Bank pleaded guilty in the United States and agreed to a $2 billion penalty for defrauding American banks about the true nature of its Estonian customers. Individual facilitators were eventually pursued as well. In early 2024, a Danish court handed multi-year prison sentences to intermediaries who had helped launder enormous sums through the network. After the largest such scandal in European history, some human beings finally faced a cell, a rare outcome in a field where the corporation usually pays and the individuals walk free. Danske Bank showed what the machine can do when a genuine banking license is placed at its service. 200 billion euros through one small door. But so far, every case we have examined has been about hiding money, obscuring where it came from. Our next story is different. It is about what happens when the laundered money is meant to be seen, flaunted in the most public and glamorous way imaginable, bankrolling Hollywood films, super yachts, and masterpieces of art. It is the story of a young man who stole from a nation and spent it in the open. In 2009, the government of Malaysia set up a state investment fund called 1MDB, meant to drive national development with borrowed billions. Instead, it became the vehicle for one of the most brazen thefts in modern history. Prosecutors would later allege that around $4.5 billion was siphoned out of the fund between 2009 and 2015. At the center of it stood a young Malaysian financier named Joe Low, a man who held no official position at the fund whatsoever, yet somehow directed the movement of billions through a global web of accounts. And the theft ran straight through the heart of Wall Street. The investment bank Goldman Sachs helped raise around $6.5 billion in bonds for 1MDB, earning enormous fees, and vast portions of that money were diverted almost immediately into offshore shell companies controlled by the scheme. Money meant to build power plants and infrastructure for a developing nation was rerouted, layered through accounts in Switzerland, Singapore, and beyond, and transformed into the private playground of a handful of men. Goldman Sachs would eventually reach a settlement of around $2.9 billion with the Malaysian government over its role. Then came integration, performed with a spectacle the world had rarely seen. The stolen billions bought a $250 million super yacht. They bought masterpieces by Monet and Van Gogh. They bought luxury real estate in New York, Beverly Hills, and London. In an irony almost too perfect to invent, some of the money helped finance a Hollywood film about greed and financial excess on Wall Street. The clean money did not hide in the shadows. It walked red carpets and docked in Mediterranean harbors, hiding in plain sight behind the glamour of legitimate wealth. The political dimension is what elevated 1MDB from grand theft to national trauma. Malaysia's own prime minister at the time, Najib Razak, was found to have received hundreds of millions of dollars connected to the fund flowing through his personal accounts. In 2020, he was convicted of corruption and abuse of power, and later sentenced to 12 years in prison, a sentence later reduced. A sitting head of government had been implicated in the looting of his own country's future, and for once the man at the very top was held to account rather than the abstraction of a company. 1MDB is the purest illustration of the whole journey. Stolen state money, placed through respectable banks, layered through offshore shells, and integrated into yachts and paintings and mansions and movies. But even as investigators unraveled it, the ground beneath money laundering was shifting. A new technology was arriving that promised to move value across the world instantly, pseudonymously, and beyond the reach of any single government, and criminals noticed before regulators did. The next frontier of laundering would not be a Baltic branch or an offshore shell. It would be written in code. When cryptocurrency arrived, it looked to some like a launderer's dream, value that could move across the planet in minutes without a bank, recorded under strings of letters and numbers rather than names. In 2016, a hacker broke into the cryptocurrency exchange Bitfinex and made off with nearly 120,000 Bitcoin. For years, the coins sat, glowing with stolen value, while the thief and his wife tried to wash them clean through a dizzying series of techniques: fake online identities, automated microtransactions, darknet marketplaces, and even converting some of the loot into gold coins that were physically buried. But cryptocurrency held a secret that criminals underestimated. Most blockchains are not anonymous. They are permanently, publicly recorded. Every transaction is written into a ledger that anyone can read forever. In 2022, United States investigators followed that ledger and seized around $3.6 billion worth of the stolen Bitfinex Bitcoin, at the time the largest financial seizure in the history of the Department of Justice. The couple behind it, including a woman who moonlighted as an eccentric online rapper, pleaded guilty. The very technology meant to hide the money had preserved a perfect map of the crime. The bigger battleground, though, was the exchanges themselves, the platforms where crypto meets traditional money. In November 2023, Binance, the largest cryptocurrency exchange in the world, pleaded guilty in the United States and agreed to pay penalties of $4.3 billion. Prosecutors found that the company had operated without the basic anti-money laundering controls that banks are required to maintain, allowing illicit funds and transactions with sanctioned nations to flow across its platform. Its founder pleaded guilty to a personal charge and stepped down. It was one of the largest such resolutions ever reached, and a signal that the crypto frontier was being brought forcibly under the old rules. Yet the most sophisticated launderers had already adapted, blending the new tools with techniques as old as trade itself. In the underground banking networks that link Asia and the Americas, brokers now run vast mirror exchange schemes. A cartel's dollars stay in the United States, a Chinese client's yuan stays in China, and the two are matched through a broker so that value effectively teleports across borders without a single suspicious international wire ever being sent. Cryptocurrency and resold merchandise serve as the balancing weights. No cash crosses the border, and only the ownership of it does. This is the frontier as it truly stands, not a lawless void, but an arms race. Every new technology that promises to move money freely becomes, first, a tool for laundering, and then eventually a battleground for regulation. Crypto did not abolish the three doors, it simply built new ones. But whether the money travels by wire, by trade, or by blockchain, almost all of it still depends on a single ancient trick: the ability to own something without anyone knowing your name. And it is over that trick right now that the most important fight in the entire war is being waged. Strip away the yachts and the blockchains and the offshore drama, and money laundering reduces to one essential ingredient: anonymity of ownership. The shell company works because no one can easily see who is behind it. And for decades, one of the easiest places on earth to create an anonymous company was not a tropical island, but the United States itself. States like Delaware, where a company could be formed in minutes for a small fee without ever naming the human being who truly owned it. It was often easier to register an anonymous company in America than to get a library card. To close that gap, the United States passed the Corporate Transparency Act, which required most companies to report their real beneficial owners to the Treasury. A central registry so that law enforcement could finally see the humans behind the paperwork. For anti-corruption campaigners, it was a landmark, the single most important American reform against dirty money in a generation. The machine's core component, anonymity, was finally going to be regulated at the source. And then, almost as soon as it took effect, the reform was hollowed out. In March 2025, the Treasury's Financial Crimes Bureau issued an interim rule that removed the reporting requirement for domestic United States companies and United States persons, applying it only to certain foreign companies registered to do business in the country. By the estimate of critics in the Senate, The change exempted more than 99% of the companies originally meant to be covered. Two prominent senators warned that it directly undermined the law's core purpose. The Anonymity Machine, having been briefly switched off, was very substantially switched back on. For domestic entities, at least. The same tug of war is playing out over real estate, the launderer's favorite destination. Recognizing how easily anonymous companies buy American property, the Treasury finalized a rule in 2024 requiring professionals to report the true owners behind certain all-cash residential purchases made through companies and trusts. But implementation has been repeatedly delayed, pushed back into 2026, and challenged in court. Each reform advances, then stalls, each loophole is named, then survives. The gap between announcing a rule and actually enforcing it is precisely where the money continues to flow. This is the quiet front line of the entire war on dirty money. Not dramatic raids or billion-dollar fines, but the unglamorous fight over registries, reporting thresholds, and who is allowed to own something in secret. It rarely makes headlines, yet it determines everything. Because as long as a person can own a company, a mansion, or a fortune without their name ever being attached to it, the three doors will keep swinging open. Which leaves us with the hardest question of all, not how money laundering works, but why, after all we now know, it is still allowed to. We began with a number that could not be pinned down, somewhere between $800 billion and $2 trillion laundered every year. And now we can see why it stays so stubbornly hidden. It is not hidden by clever criminals alone. It is hidden by a system that profits from moving money quickly and privately, by banks for whom the fines are survivable, by jurisdictions that sell secrecy as a product, and by a political will to reform that flickers on and then quietly off. The money is not lost in the shadows. It is circulating all around us, wearing a clean shirt. Look back at the road we traveled and a single pattern emerges. Whether it was a Baltic branch moving 200 billion euros, a global bank waving through narco-dollars, or a fugitive turning a nation's savings into a super yacht, the crime almost always ended the same way, with a corporation paying a fine it could afford, and the individuals who benefited most keeping their freedom, and very often their fortunes. The penalties are real, but they are priced in. For an institution earning billions, a billion-dollar fine is not a deterrent. It is a line item. And there is a cost, even if you have never touched a criminal dollar in your life. Laundered money distorts the world you live in. It inflates the price of the homes in your city, bought by anonymous companies as vaults for stolen wealth. It rewards the corrupt official over the honest one, the cartel over the community it terrorizes, the kleptocrat over the citizens he robs. Every dollar successfully washed is a vote that crime pays. A subsidy drawn from the rest of us for the people willing to steal on the largest possible scale. The war is not lost. The FinCEN Files existed because someone leaked them and journalists spent years decoding them. The Laundromats were exposed by investigators who followed shell companies across dozens of countries. Beneficial ownership registries, real estate reporting rules, and blockchain forensics are all real weapons, and they have drawn real blood. The tools to trace the money exist. What remains uncertain is whether the will to use them can survive the enormous patient pressure of those who profit from keeping the doors open. If this pulled back the curtain even a little on how the money really moves, consider following the boardroom, where we follow the money others would rather you never trace, and share it with someone who still believes the world's dirtiest fortunes stay hidden in the dark. Tell us in the comments which system you want us to open up next. The tax havens, the sanctions evaders, the offshore trusts. Because once you have seen the three doors, you cannot unsee them. And the next time you hear that a fortune came from nowhere, you will know exactly where to look. Follow the money, it always leads somewhere.